In this incremental analysis video, I'll cover the basic analysis for retain or replace equipment. On January 2nd, County Hospital purchased a $100,000 special radiology scanner from West Inc. The scanner had a useful life of 4 years with no disposal value. The straight line method of depreciation is used. Annual operating costs are $105,000. Approximately 1 year later, the hospital is approached by a Smith Tech salesperson who indicated that purchasing the scanner in 2017 was a mistake. She points out that Smith has a scanner that will save the hospital $30,000 a year in operating expenses over its 3-year useful life. The new scanner will cost $110,000 and has the same capabilities as the scanner purchased last year. The new scanner will have no disposal value, but Smith Tech agrees to buy the old scanner from County Hospital for $40,000. So the first thing we're going to look at is if County Hospital sells its old scanner on January 2nd, 2018, what is the gain or the loss on the sale? In order to calculate gains and losses on the sale, we first need to look at depreciation. And so the initial cost minus salvage value divided by useful life is how we find our annual depreciation. So if we go back to our paragraph, the initial scanner price was $100,000. It has a 4-year useful life and 0 salvage value. So we can calculate that annual depreciation is $25,000 per year. Next, we need to determine what total accumulated depreciation is. Well, in this case, only 1 year has gone by. So we would just take our $25,000 annual depreciation times 1 year to determine that the accumulated depreciation so far is $25,000. Now we can look at the book value of the equipment. Our book value is our cost minus accumulated depreciation. And so again, we take the $100,000 initial cost minus the accumulated depreciation of $25,000 to determine that the current book value is $75,000. And lastly, when we compare the book value of $75,000 against the proceeds, which is the $40,000 that Smith Tech agrees to buy the scanner for, we can see that that would result in a $35,000 loss on the sale. And so the journal entry they would do for the sale of the equipment would show that $35,000 loss. However, that really has no impact on our decision as far as whether or not to retain or replace the equipment. So now we're going to use incremental analysis to look at that question. So if we set up our table here, first we're going to compare our operating costs. So first we need to look at our operating costs. So the old machine has $105,000 in annual operating costs. It has a total of 4-year useful life, but remember 1 year has already gone by. So we're going to compare over the total remaining useful life, which is 3 years, to determine that the remaining operating costs are $315,000. Now, if we choose to replace the equipment, the problem tells us that the new equipment would save the hospital $30,000 a year in operating expenses. So we can figure out that the annual operating cost would go down from $105,000 to $75,000. And this machine also has a 3-year useful life. So if we multiply that by the 3 years, we can see that total operating costs for the new equipment would be $225,000. And so this decrease in operating costs, if we replace the equipment, causes a $90,000 increase in net income. Now, of course, if we get a new piece of equipment, we have to pay for that equipment, and the problem tells us that the new scanner will cost $110,000, and so we have to add that into our table. And since, of course, if we kept the old one, we do not include the purchase price because that additional $100,000 purchase price is a sunk cost. We already paid it. So we're only comparing our 0 if we retain it to the purchase price of the new. That would cause a $110,000 decrease in net income. But don't forget, if we do choose to replace the equipment, we will get that $40,000 for selling the old machine. And so we put that in our replace column of our table because we can only get that $40,000 if we replace. We can't retain it and also sell it. However, that money coming in is a reduction in our cost, so we show it as a negative number in our replace column. But that reduction in cost causes an increase in net income, so we show it as a positive number in our net income column. And so now when we add up all of our numbers, we can see that if the company chooses to replace the equipment, it would actually cause a $20,000 increase in net income over the 3 years. And so because it's a positive number, the company should choose to replace the equipment.